I mean, all sorts of interesting news in China about inventories.
I'd say that throughout the year, we've probably actually deepened the deficit position.
You can buy a dip like this and see higher highs later. Welcome back to Rockstock Channel. It's Thursday, June 4th, and we've got a packed Rockstock recap episode this week. Joining Matt, Rodney, and me for the first time today is Chris Williams of Adamas Intelligence, one of the industry's most respected independent analysts covering lithium and rare earths. We'll also feature a short highlight reel from our recently published interview with Q2 Metals' Neil McCallum. Earlier this week, we published interviews with Benchmark Minerals' Brian B. to preview their flagship Giga USA conference in Washington, D.C. next Tuesday and Wednesday, and also with Benchmark's Cameron Perks, whose most recent lithium forecast has received a lot of commentary on social media. We thought it timely to hear directly from the bear's mouth. Benchmark continues to forecast stronger lithium prices through the balance of 2026, but growing risks of oversupply emerging in 2027 as project restarts and new supply additions begin to catch up with demand growth. Their long-term incentive price remains approximately $22 per kilogram LCE. We encourage you to listen to that interview and check out the show notes for a link to the Giga USA agenda and to register for this important event. On the rare earth side, there was a lot of company updates and deal flow. USA Rare Earth announced up to $1.6 billion in government support from the CHIPS Act for a magnet plant in the Carolinas. Ionic Rare Earths and Nth Cycle announced an MOU to collaborate on rare earth refining technology. And finally, Hyperion X delivered a robust DFS for its permitted shovel-ready Titan project in Tennessee, which was funded by the Department of War. 39% IRR and less than 4-year payback on relatively low Phase 1 CapEx of just $230 million. Lithium remains a core focus of RK Equity, but has also been the gateway drug to other critical minerals. I'm looking forward later this month to host my first ever Rare Earths fireside chat at Fast Markets' flagship conference in Las Vegas with MP Materials' Matt Slauscher. Originally, I thought we'd be interviewing as well Don Swartz of Rare Earths Americas on that same panel, but unfortunately he was not able to attend Fast Markets, but will be, or the company will be represented at the Benchmark Giga USA next week, and I look forward to following up with them there. We'll also be catching up with Craig Shesky of the Metals Company. So, with seafloor mining, rare earths, phosphates, we're going to continue exploring how rare earths, as well as, phosphate and graphite and titanium and other strategic materials increasingly intersect with the same reshoring and national security themes that first attracted many of us to lithium, and we encourage all of our viewers to do the same. Before we begin, a reminder that RK Equity may be an advisor to and or hold equity interest in a number of companies we may discuss in today's video. But of course, we are not financial advisors, and nothing discussed should be considered investment advice. Please do your own research and read the disclaimer at the end of this video. I'd also like to thank our sponsor, Clean Elements, an investor group focused on providing growth capital to critical minerals developers supporting the energy transition. Clean Elements has invested more than $30 million to date and is currently the largest shareholder of both Galan Lithium and Noah Lithium Brines, two companies developing high-grade lithium brine projects in Argentina. And with that, welcome Chris Williams, who we promised on Twitter after some heavy engagement back and forth. You've been very prolific, Chris, tweeting about lithium, in particular, hard rock lithium in Quebec. But I know you've traveled quite a bit to some other jurisdictions, and we're excited to have you on. Why don't you give us a bit of your background, and also Adamas Intelligence, which we, a few years ago, we partnered with Ryan Castillo and had some rare earths coverage or a conference. Adamas has really carved out a name as a great research provider in rare earths. You have a conference in September that is kind of like, the Fast Markets lithium for rare earths, but you're the lithium analyst based in, Vancouver. Just tell us a little bit about Adamas, what it does, and yourself and what you cover. And then Matt and Rodney and me will have a good discussion.
Oh, thanks for having me, guys. Yeah, it's a real honor to be on the show. I've been watching the channel pretty much since day one, so yeah, it's a real honor to be on. So yeah, Adamas Intelligence has history dating back to around 2011 when the founder Ryan Castillo started the firm in Europe and so slowly built his name across the rare earth industry in particular, and in more recent years into the battery metals, and that's sort of where I've come into the picture. So yeah, our services, range from consulting to advisory to research reports that we put out on a monthly, quarterly, annual basis. Um, Myself, I'm an engineer by trade, and I've sort of come into the industry rather organically. Purely just following my passion, really. I started my career in oil and gas and sort of slowly moved into mining. Um, I was previously working for Anglo American in an operations type role, and then slowly just became enamored with supply chains and particularly like these sort of critical minerals, battery metals, etc. And gravitated more recently into covering lithium, and so by virtue of that, I've been following a lot of your guys' content on this topic, which has been super helpful for everyone to get up to speed. I think whether you're retail or institutional investor or whatnot, I think it's a really great service you guys are doing. So um, yeah,
We
so
didn't
so
pay you for that promotion, but thank you.
yeah, no, yeah, it's an honest assessment for sure. Um, Yeah, from here, we are hosting, as you said, a rare earth conference every September. We're up to number 3 this year. So please jump on our website and check that out. It's been really successful. We've had a lot of great feedback from that. I go every year. I might even be speaking this year, so we'll see.
Okay, great. Matt, Rodney, we have some questions. I don't know who wants to go first.
Matt first.
Okay, I'll jump in. So, Chris, you've posted quite a lot on Hard Rock recently, and I'm sure we'll talk about Quebec and the various projects there. But I wanted to come back to a piece you posted, sort of, I think it was towards the back end of last year, after you did a site visit to the Centenario project, the Aramet project in Latin America. And of course, DLE is one of the big questions in the lithium space. And I thought you had some quite interesting takeaways from that site visit. So could you just sort of talk us through those in a little bit more detail?
Yes, certainly. So, I guess as a broad picture, I look at DLE much like any analyst should with regards to brine resources. In that you're talking about a really particular type of resource that needs to be handled accordingly on a resource by resource, flow sheet by flow sheet basis. So therefore the technology de-risking pathways are really dependent on sort of who's involved in the team, whose technology is being used. Is it in-house versus third-party provider, for example? So Aramat was a great example of a project that has really been born internally within the team from a grassroots perspective. They had scientists working on the deposit for like 15 years. They built the technology that underpinned the flow sheet, namely they built their own solvents, and they designed the flow sheet tailored specifically for that deposit itself. A lot of those team members are still with the team, the development team there. So you have that continuity of knowledge going through the organization, and they've really stuck their neck out and put like $1 billion of capital into the ground in like a really rural part of Argentina, and it's really quite impressive what they've been able to achieve here. And when I take my learnings from that site tour, really it's really just confirmed an overall thesis that I've built on the sector, which is to say that if you are serious about DLE, then you're most likely going to have to really do the hard yards to build in that internal capability to be successful. On the other end of the spectrum, and we did see a lot of this hype the last lithium cycle that we had. You have a lot of say junior players that don't have that much resources, and they're having to rely on third-party vendors. I am a lot more skeptical about those sorts of stories, as it pertains to actual delivery of lithium tons at the end of the day, and therefore investor returns. So for this pool of operators that I would classify as highly advanced and adept at pulling this off, Aramat's right up there, obviously, and then we've got other players like Rio Tinto, and I would actually also put Vulcan Energy in that same bucket as well.
And Exxon, possibly.
Well, yeah. So with the oil field players, I mean, Exxon, it's a bit of a black box, I guess, with regards to like public disclosure from those teams. Um, here we're talking about an outfit that has deep access to capital, but it's also fighting against the hurdle rate within the organization. So how serious that firm will end up being with regards to advancing its DLE prospects in Arkansas, I guess, remains to be seen. One thing that I like to do is really just track the careers page on Exxon, and just to see how many people are being hired into the team. And every now and then you'll see some job postings related to lithium, but it certainly doesn't seem to me, like when we look at Vulcan Energy, for example, like that's a small junior that has like 300 employees. I think the Exxon lithium team would be like a tiny fraction of that. So it helps for perspective, I think.
I mean, I think the other thing that sort of people maybe mistake about DLE is that they just look at DLE and go, it's one asset class. But obviously it's not. I mean, you've got salar brines, you've got oil field brines, you've got geothermal brines, with a very different geochemical sort of breakdown. And I think the point that you make about having done the work is really important. When a junior turns around and says, "Oh, you're going to go DLE," I'm like, "Well, come back in 5 years," because you have to have done the very detailed sort of workup on the brines. Talking to people who've launched DLE projects, a lot of the off the shelf technology that you see, is not viable once you hook it up with a real brine. So the technologies have to be tailored to the specific ore bodies that you're looking at, and that can take many years.
Yeah, absolutely. I'd totally agree with that. Yeah.
Chris, I want to. That's a bit of a contrarian take on Vulcan. We have not talked about that company to a great degree. And so I want to dig in a little bit on that, but I don't know that I agree how fair that comparison is. Vulcan's fully funded. They've raised, billions, I guess. So they've hired 300 employees to do that. Exxon has not yet made an FID, nor has Standard Lithium, in the smackover. And the hiring, that was done, at Exxon was done kind of like a few years ago, right? So those people, we know them, they have a decent staff of people. They're still showing up at conferences, and the like. The question is, will they get to FID? Your point is very well taken that will it get, this is just a project among, their low carbon solutions, many projects. So like when it gets to a certain level on the board, will the people promoting this project internally, pass muster, with that board? And then that board is going to make a decision, just like the public equity markets would kind of make the decision. What are the return? Do the returns stack up? And they read Goldman Sachs and Morgan Stanley reports and see volatility in pricing. So I think they have definitely slowed their timeline, like everybody, right? Vulcan, we talked about, 5-6 years ago, was supposed to have been in production, I don't know, last year or the year before. So, I remember having Garrett Fueling, Rodney, remember when he first kind of came on, he talked about, that coming on stream. Yeah, DLE will happen, but it'll happen in the latter part of this century. And he was right, about that. But again, to get to FID, right? As in Europe has not many projects, and the story of Vulcan is very compelling, especially to European ears, right? The zero carbon lithium, you're not mining something, and they did a fantastic job in securing, offtake agreements from brand names, and then export credit agency financing and the like. But when push comes to shove, when they had to actually go for the equity, it was very, very, very dilutive. The surprise to a lot of the shareholders there. And at the end of the day, I think YJ Lee was saying, like, the capital intensity per ton for not a very large quantum of lithium tons, right? What do you think? Like, I mean, do you really like this project? Like, yes, it's gotten funded. Yes, it's going to become part of the supply, hopefully, et cetera. But, tell us the evolution of your thoughts there and how you think that compares to some of the smack over in America, and I guess the Leduc in Alberta, you're based in BC, and the Salton Sea, and even in Utah, Anson and Pasco. There's a lot of activity, happening in DLE elsewhere. How do you think about all of that?
Yeah, well, I think it's really important in this case to think about the local context of where Vulcan sit. So, as you rightly point out, on a global scale, the economic merit of the Vulcan project has sort of become a bit more challenging as it progressed through feasibility studies and to final funding. But when you consider like the predicament that Europe is in, it's really the first cab off the rank in terms of locally sourced lithium units. Now, if we look at, say, like the CRMA regulation, like they have targets domestically to source 10% of their consumption from domestically sourced lithium units. So, Vulcan is really one of the key projects that will fulfill that by 2030, when it probably starts to be ramped up to full production. So this is actually a really important case. I think sometimes when diligencing assets, you cannot look purely at economics. You have to think about the jurisdiction and the context it's within. I mean, I would liken this to like a Thacker Pass sort of situation. Thacker Pass is a very expensive project, but because of where the US finds itself bifurcating from China with regards to supply chains, it's got this sort of national security sort of angle behind it. So, and yeah, just another thing I'd touch on briefly. I think as I followed Vulcan from its early inception, it became clear to me that they were a very serious DLE player. Like, these 300 employees have actually been in place for quite some time. The company took a very aggressive vertical integration strategy. So they started off with just like an owner's team, and then they slowly, they bought the subsurface geothermal know-how within the team. They bought drilling rigs and the teams associated with those drilling rigs under the umbrella. And I guess they've just been really savvy with, getting as much support from local, state, and federal governments within the EU to build their project. And in the end, it was quite dilutive, unfortunately, for existing shareholders. But I think the overall package of the project meant that it sort of had to go through for the EU to achieve its goals.
Okay, great. Matt?
Yeah, sure. Okay. Quite an interesting post you made a couple of days ago on Q2, moving to Quebec, where you looked at some of the transaction multiples for that have been transacted in space over the last sort of 2 or 3 years, and applied that to, the Cisco resource. Can you talk us through that? Because there were some quite interesting, impressive numbers on that.
Yeah, sure. Just for a bit of fun, I guess. I've got a chart there showing the comparable spodumene transactions and current share price inventory evaluations from peers. And so, because Q2 has come out of the gates with its initial maiden resource estimate, nearly 300 million ton at 1.36% lithium oxide. Now, because that's such a large denominator, if we just, I think it's helpful for investors to just take a look at, okay, yes, it's got, whatever, 400 million USD market cap, but that denominator is so big, and the resource really is so significant that when you stack it up against peers, you'll actually find that it's relatively cheap on that basis. Now, there is often, with these sorts of metrics, it's not the be all end all with regards to the way finance professionals sort of look at these sorts of things. But it is indicative nonetheless, I think, just sort of as a first pass assessment of how expensive the stock is relative to peers. And right at the top of that chart, you'll see the holy grail of transactions, really, for this type of project, which is the SQM Hancock transaction for the Azura deposit, which on an equivalent Q2 share price basis would put Q2 at $20 per share, and it's currently trading around $3. So,
how do you arrive at that if Azure never published a resource?
sorry, yeah, that's a really good clarification. So I'm just using the midpoint of the exploration target which they published, which I think I've written on that graphic there. I think it's 175 million ton at 1.25%, something like that. But yeah, they have not yet disclosed a mineral resource on that one. So it is, I mean, a lot of this is quite dubious, but it's, I think, directionally indicative of something.
Okay. Well, your lips to God's ears, the Q2 is a $20 stock.
And I mean, Chris, you've been back in last year. I think you were on a site visit to Quebec, and you've walked over certainly the Shaki pegmatite, the Cisco pegmatite. What was your sort of takeaway from going to those two different sites?
Yeah, certainly. I mean, that was such an eye-opening trip. First time to that part of the world for me. Had the opportunity to go catch the plane up to Saskatchewan's site and see the whole layout of the project up there, right from the airport, the hydro plant that they're going to plumb into, the field camp, and we got helicopters to the actual ore body itself. So that one's really neat. I guess when comparing to Q2, which a lot of people like to do, I think they're really quite different projects. Obviously, one is quite rural compared to the other one, but PMET has some really exciting mineralogy, and they just released some more information on that this week with regards to some cesium outcrops that they've discovered. So yeah, there's really it's a multi-commodity, high byproduct credit, but also high capex style of project, whereas something like Q2 is more plain vanilla. Keep it simple, stupid, as you guys like to say. And it's closer to infrastructure. So it's so completely different profile opportunities. But yeah, no, that trip I was really fortunate to go on that.
I think PMET, has been talking a lot about cesium, but tantalum is a very much bigger is a bigger market, but also I'm just hearing from, military and defense applications. Like cesium seems to be like a small end market, but they're talking about supply creates its own demand, right? It's just very constrained, but tantalum is very already known. Anyway, I would suggest, PMET may want to talk up the tantalum bit, but it's interesting you point that out. I mean, and Pilgangoora, I think, has tantalum in it as well. In the early days of Pilbara, that was talked about a fair bit, but you don't hear enough about tantalum, I think, in the discourse lately.
Well, most of the Aussie hard rocks are producing tantalum as a byproduct. I mean, PLS is definitely producing quite a lot of tantalum as byproduct credit. So, it's there. I mean, these are LCT
Right.
pegmatites after all, and most of them have tantalum in.
Just one thing, Chris, I just wanted to ask if you'd looked at all, when you did that comparison, if one looks at all at NPV models as a relative, just to get a sense of capital structure and time to production and a reasonable discount rate as a sort of cross-reference to tonnage.
Yeah, I mean, it's certainly something one would do or should do when doing a deeper dive into valuations, really bringing in that time value of money factor.
And
yeah,
capital and infrastructure costs, I think, is also important. Yeah.
Yeah, absolutely. I mean, the way I look at capex intensity is it's really important when it comes to development projects, obviously, and it really just highlights how much dilution really is necessary or coming down the pipe if you're involved in a particular story. You're going to want to have to reduce that risk as much as possible. And it also relates to scalability.
Yeah,
so
look, I think it's always tricky in terms of timing of these things. If you raise it at the right time in the cycle, the debt and the equity is not that tough. If you raise it at the wrong time, it's brutal.
Yeah, exactly. I mean, if you're looking at world-class deposits with low capital intensity, those things are really scalable. And so any analysts that looking at supply and demand flows, you should be sort of cognizant of that. But if you're looking at something like these geothermal brines or something like Thacker Pass, for example, like the clays. These are really high capital intensity projects. So, yes, they're geologically scalable, but there's a capital sort of bottleneck there to how much those resources can scale.
Chris, on that comment, we've done some work. Matt's done some work, but like Thacker Pass is an integrated project, right? It's mining plus it's making chemicals. You can't compare the capital intensity of that just to like a pure spodumene alone like project. I think brines are cheaper over time overall, but also this concept of like Thacker Pass, $3 billion, that's a big project, the most ambitious project we've called it, in the lithium industry, like ever attempted. Right. But that's not that big of a project, compared to like a copper porphyry project that Matt rightly pointed out to me. When you're doing a copper porphyry project, most of those capital intensities are just to make a copper concentrate. If you then would add a smelter to that, right, the capital intensity, per ton would be probably as high, as, Thacker Pass's, capital intensity per ton. So, and Bechtel, which is building Thacker Pass, a $3 billion project, that's tiny, right? You were in the oil and gas industry, a $3 billion project's not that big, right? So the world needs, I have these debates all the time. I mean, America needs, the ex-China world needs the midstream, the chemicals, and the PCAM and the CAM. So I think like hard rock has a huge place, right, in that, you know, in North America, but you need some people to convert the you know, the hard rock, you know, in North America. And right now you really only have Tesla, and like, so project by project comparison basis is what I'm saying, is that you have spodumene producers that don't have like a downstream vertical integration plan. Very few do, or if they do, they disaggregate it. They say, okay, we can do the hard rock and then maybe we'll do, you know, the downstream. Whereas brine projects typically, you know, and clay projects and DLE projects, you know, have to go, you know, the whole shebang, right? So down to chemicals.
Yeah, no, it's a fair point. And for the case of hard rock, you can model the effect on economics of having to put in a refinery on top of that. And if it's not directly integrated, you can sort of model that as a selling cost, or you can just factor in a third party's capex intensity on top of that as well. So there's different ways to handle these, and you're absolutely right. Like it's challenging to compare like an intermediate product's economics directly with a chemical level product. So that's project. So for me, like when I do my analyses, one thing that I'm always doing is harmonizing everything at the chemical level, so that way there's no ambiguity about, hang on, you're comparing like a spod con with a battery grade chemical, for example.
Chris, yeah, so you've also done some quite interesting stuff on incentive pricing, and I think that probably that last question follows on quite interestingly. So, you know, if you look at maybe the cost curve, you find that sort of brine assets are probably around about the bottom of the cost curve, and hard rock assets are, you know, middle of the cost curve, and then obviously you've got the sedimentary and DLE where we don't really know, but probably sort of second or third quartile. But if you then whack in the incentive prices, you get a bit of a turnaround. So can you talk a little bit about your calculations on incentive prices and what that, you know, if you include an incentive curve, if you will, which includes the capital cost plus the operating cost, what does that then do to the industry?
Yeah, sure. So I like to spend a lot of time looking at incentive prices purely because they relate more intensely for development projects, whereas a cost curve really is more important for producing assets, I think. So, you know, I've got a graphic here that sort of explains, on average for development projects, where by resource type, where they generally land on a cost curve and an incentive price curve. So, when we're looking at a cost curve, really what we're thinking about when we're looking at these is how defensible is a project or a resource when it comes to like the troughs of price cycles. But when we're also considering a capital charge on top of this, we're looking more broadly at the overall economics of the project itself, because it's incorporating economic returns on capital. Now, when I do this analysis, I'm using like a 30% corporate tax rate assumption, and also I'm expecting, on average, I believe the industry needs about 20% return on invested capital. So when you flip from a cost curve to an incentive price curve, really the traditional order in which we view lithium assets flips on its head. So as you say, you know, hard rock on a cost curve is sort of like in a marginal producer position right at the top of the cost curve. But when you consider how cheap capex is, particularly if you're refining in China, you know, that becomes in aggregate one of the most attractive opportunities. So when it comes to, I think it's important to highlight, you know, why I really like hard rock as an asset class in general is, if you are able to find a really good deposit, you are able to bring your project right down to the center of the cost curve, so that it's, you know, defensible during troughs of the bear markets. but you're actually, by comparison to other classes, you're the most economically attractive, because it's really like akin to like a high beta stock on the stock market. When prices come down, like we saw like 2 years ago, a company like PLS was sort of maybe losing a bit of money, 100 million or so per quarter. They didn't really have too much balance sheet stress, but as soon as prices turn, and we've all seen the performance of PLS, it's just an absolute rocket ship straight up. So it's a high beta way to look at lithium. Whereas if you were to express the same capital into something like a brine at the troughs of a bear market, it's still making money, which is great. But when prices go up, on a return on capital basis, it's not as high beta, so it's less torqued. So that's sort of like how I like to frame things.
But one question on that. I mean, the way that PLS works is that only worked because it was selling its product into China. If it was fully integrated in Australia, or for instance had a refinery, say in the US or whatever, it would not have been able to make ends meet in the same way.
Absolutely, yeah. So I estimate that by integrating in the West and paying Western rates for a refinery, you're in general adding about $8,000 per ton to the incentive price. Now that relates purely to the capital intensity of refineries themselves. Like in China, in general, they can build a refinery for about 10,000 per ton per annum. But in the West, it's closer to 40. So it's like 4 times the price. We really aren't comparing apples to apples here because there's different regulations involved. But that's really the point. Like the standard at which Western operators have to adhere to is much higher compared to China, at least historically. So this really affects the economics of integrated hard rock within the West. Now, I also have another graphic here on, the way the incentive prices differ from project to project within each of the resource groups. Now, hopefully we can show this. It's a little bit complicated to interpret, but basically what we're showing is like the distribution that you can see from known feasibility studies and construction cost from various projects that are out there. These are sort of like normal curves where you want to be on the left side of the curve and sort of stand out that way. But the bulk of the projects will be sort of in the middle of the curve. Now, what's important to interpret here really is that, I've got highlighted several really prominent projects on here, and it's showing that, a lot of the key projects that are up and running at the moment are actually running on a very high incentive price basis, which is to say, in order to return 20% for their investors, they're going to need 25 to 30 dollars per kilogram lithium carbonate, basically for the first 5-6 years or so. So that's quite significant. Economics really aren't everything when it comes to project development. Like a lot of these projects, like I mentioned earlier, are sort of like strategically important to their relevant jurisdictions. But on the other hand, if you are purely looking at economic returns, something like Greenbush's CGP3, stands out as like an exceptional brownfield expansion. The same thing as Kochari-Olaroz and some of these other examples. Mount Holland is another example on there. So that's a good example of a Western integrated project that is that project only needs like 20,000 per ton to return 20%. So it really helps to sort of frame the conversation around economic returns.
Okay. And you've also got a really interesting chart here, where you sort of put the cumulative supply incentivization in there. And if I'm reading this right, you're saying that at a $20,000 per ton price in the market, we could maybe get sort of 2.5 million tons a year of production. But if we got a $30,000 per ton price in the market, potentially we could get 4,500 tons a year of incentivized production. Is that the right way to read that chart?
Yeah, so the chart that I've got here really is what I've taken that previous, those distributions that I showed previously, and I'm multiplying that by the project library of all the possible projects that are out there. Now, what I mean by possible is there's obviously, when you're doing these sorts of analyses, you're sort of bucketing production units into different categories. So this is not considering in production, in construction, ramping up, or highly probable projects, which is like another category that I use explicitly. So this is really like looking at the types of projects that will respond to different price signals. Now, whenever we have a typical assessment of like long-term demand, and we have known buckets of production coming into the market, there's, with lithium growing at 20% per annum, there's always a gap shown in these sorts of graphics. So how that gap is filled is extremely interesting to me as someone that is interested in development projects. Now, this curve that we've got here is sort of quantifying that using the data from the incentive price distributions. So how this differs from traditional methodologies is basically, a firm might make individual assumptions on an asset by asset basis. But what I'm doing is I'm saying the entire industry of developers needs a 20% return, and we know from the sample of data of all the feasibility studies that are out there, how those returns are likely to be met based on what price. So you can project out into the future depending on how bullish you are on demand. Now, in this example, I'm using the year 2035, and you can say, okay, we have, as you say, you could say we have a 2.5 million ton deficit in production in that year. Therefore, we need 20,000, or the gap may be even larger. So you see all sorts of weird quirks when you're doing this sort of analysis. So on one hand, if you are inherently bullish on prices, you are also saying that pretty much all of your peers will come into the market, and there'll be all sorts of different types of new technologies and whatnot coming into the market. But also, if you're not so bullish, it means by virtue of not being bullish, you're writing off the potential of high cost assets that are out there. So pretty much, if you're viewing anything less than an incentive price of like 20, 22, 23,000 roughly, you're basically saying Western refinery projects are like completely dead in the water and will not work, economically speaking. And I think we've seen this sort of commentary echoed by folks like in Albemarle, for example, who have sort of said similar things.
Albemarle said that explicitly. 20 to 25 is what they need,
right,
to do the mega flex in Carolina. And what's interesting is that they used to consider themselves purely vertically integrated chemical kind of company, but they shut down Kemerton and are happy to sell spodumene at high, they bifurcated internally, and they have to, I guess, for tax reasons as well in Australia. But when they look at things, I'm not exactly sure if they look at it, completely on an integrated basis anymore. I want to comment on what you said about Pilbara has this torque to prices, and brine companies have not really had that torque to prices. there haven't been many brine companies that you pure play that you can invest in, really. There was Orocobre back in the day. Livent, yes, but Livent, traded with hedge funds in the US and not with kind of Australian kind of sensibilities. And they always had a lot of CapEx, projects for their growth. So you haven't really had a good comps. But you do have Lithium Argentina, which should do a Pilbara-like re-rate now that they're generating cash flow, in my opinion. But they do minority own their assets, not majority own, single asset. But I think that underpins some of the logic for Lithium Argentina to do a dual listing in Australia, because they understand that better. I think the U.S. market looks at these things as kind of chemicals. It'll also be interesting to see how Galan gets priced, as they get into production, and do they have that, they still have that Lassonde curve, going into production part, but once they're in production, what kind of leverage do they have, and how do they trade, relative to where lithium price trades. I mean, the stock was down on very good news, last week, but I think that is a result of where lithium prices went. So maybe it is very correlated to prices. Matt, you put out a post this morning about what's happening with lithium prices. Maybe we can talk about that a little bit, just for current market flavor.
Sure. Well, I mean, all sorts of interesting news in China about inventories. So, more inventories going on to GFEX, changes to the VAT and trading processes in China, which means that a lot of hidden inventories are coming into the system, changes to the way that SMM reports its inventories. They've added on another sort of inventory unit in their series. So, it all seems to be around inventories rather than any concern that the CATL project's going to come back in. But also, I think that there's some seasonality around here on prices. So prices went up very, very strongly at the beginning of May. They've come back off. Seasonally, there is weakness over the Northern Hemisphere summer, and then we tend to get restocking ahead of the strong period for EVs, which is in the fourth quarter of the year. So, got very excited about prices breaking up out of the trading range that they're in between January and April. They've broken back down into that trading range. Could they drift off for a little while longer? It's quite possible. But on the demand side, demand seems to be pretty robust. So I'm not that worried about, a huge collapse in lithium prices. And, if I'm right and prices start to sort of pick up towards the end of the summer, then this might end up being a great buying opportunity again for the lithium stocks.
Chris, what's your view? And also, if we can kind of connect it to the benchmark interview that we did, Matt, you teased out in great detail Cameron, who largely focuses on the supply side, and he defers to his colleagues on the demand side. We had noted earlier this year that Iola Hughes, who's a great analyst, but and has been behind the ESS demand story. Nevertheless, you thought, Matt, that she was undershooting on the demand side. So maybe benchmarks somewhat bearish view on lithium prices is a function of both demand and supply, but they do see a lot of supply. But I think, Chris, you may have posted, I don't know if it was in reference to that, but I called you after I saw your post on LinkedIn, you'd be very careful about being too bearish. So what are your thoughts?
Yeah, well, that post that I did was really aimed at the generalist that is looking at this and quite casually perhaps, and seeing a lot of headlines with regards to restarts. Now, what I thought I would do, and I didn't know what the outcome would be before I did the analysis, was just pull together the cumulative chemical equivalent tonnages that all of those restarts imply from 2026 through 2028. Now, pretty much, as far as I'm aware, every Australian spodumene concentrate operator has announced to some degree some are pre-FID, that they will expand or restart, except Mount Cattlin, which is sort of under Rio Tinto and doesn't have much reserve life left. So not expecting much there. But so when you add all this together, I think what you really find is that most of the tons are still a way out, mostly in 2028, but also the sheer quantum of production delays that we've seen from particularly, now this analysis is not exhaustive by any means, but particularly the setback we had from Greenbushes with its CGP3 ramp up, when you're factoring in Zijin Mining's Tibetan DLE project and also potentially the Monono project as well. Delays in all of those, like they all add up. And then also on the demand side, I think, so far this year, as we've discussed a lot on this program, I guess has been, Chinese EVs sales have been rather disappointing, sort of negative growth rates, but ESS has shot the light outs. So I sort of did some rather subjective work on this to say, okay, where was the street sort of placing these demand buckets as we went into the year versus now in around May, June? And I guess what my conclusion there was that is like ESS outperformance has outweighed EV underperformance. So net, you put all this together, and I'd say that throughout the year, we have probably actually deepened the deficit position, which may be of some surprise to like the casual viewer of these markets. I will caveat a lot of that discussion with, I mean, the supply numbers are pretty firm, but on demand, since a lot of this has gone down, we have several dynamics at play. Like higher oil prices are not really yet to be factored into EV uptake. So I think my last podcast appearance, I was sort of discussing a view for the year where we could see subdued vehicle sales because of like the economic impacts and people tightening their expenditure, but we could actually see higher market shares for electrified vehicles. And I do think that is playing out and it's slowly starting to show in the data. And then on the ESS side, I think, we all need to be cautious about inventory build-outs, particularly given bottlenecks in ESS installations. So these are things that certainly need to be looked at. And also with ESS, given their sensitivity to lithium prices, it's a debatable thing, but how much demand destruction can we expect there too? So these are all factors worth considering as the year plays out.
Chris, yeah, you just raised something that I saw, the sort of build out of solar and wind this year in China is pretty slow. I don't know if that's going to change later on or if that's a sort of a deeper issue with what's going on globally. Is that, cause for concern on the ESS inventory, battery inventory out there?
I guess when I'm doing this sort of work, you have stocks and flows. So you've got a pretty sizable inventory of existing renewable energy generation that is still yet to convert to being supported by battery. And then we also have flows. So, there'll be ebbs and flows. Some months, some quarters will be good in terms of new solar, new wind. But I think the best way to think about this is both the stock and the flow of renewables that need to be upgraded to be battery supported. So that's what I use to sort of frame my views on how much total addressable market there really is for batteries in grid applications. And then obviously we've got the theme of diversification within applications of ESS. So AI is the big emerging ones there. So Yeah, so that's sort of like, I hope that makes sense.
So one question I wanted to ask Chris, Rodney has always put in my mind that like once you hear DSO, it's the canary in the coal mine, risk of oversupply. And I saw develop, put out a press release earlier this week or last week about, start a DSO strategy, for lithium. And Matt, you, in your interview with Cameron Perks, he mentioned a lot of countries that, like Myanmar and Mozambique and Nigeria, last cycle, no one had heard of Zimbabwe, right? Or China lepidolite. And all of a sudden, yes, there was the inventories we didn't track, but, everyone's now talking about, Zimbabwe, 15% of global supply. That came out of nowhere, right? So lithium's not rare, and Africa is very opaque, and a lot of people do things in stealth mode, Chinese in particular. So my question is, Delta and the DSO, a lot of these restarts, they're cautious. And, always be careful of like what you don't know. But anyway, I think Matt, Chris, why don't you exchange your thoughts on that?
Yeah, sure. So I guess for me, like when you look at the pure quantum of DSO flows that could come into the picture, it's really quite marginal. So DSO represents a marginal swing source of supply. Um, I would caveat that though, because ex Africa, DSO really is one of like just the only ways that they can get units to market. In fact, I have heard a lot of operators in Chinese operators in Nigeria, for example, actually prefer to ship DSO because it means they're skipping out on royalty payments. They can just crush grind everything, convert at the port locations in China or near the ports, so that they sort of opt for that. So there is a sort of an element of like there's always going to be some level of DSO in the market, even in potentially the troughs of the cycles. But in general, it is. I agree, and it is a bit of a scary signal to see sort of DSO being incentivized into the market. But the pure quantum of DSO that we're talking about here is probably just like a few percentage points of difference. But maybe enough to tip the market one way or the other.
Yeah, I mean, I would agree with that. So, I mean, just put some numbers on it. Last time, the market size, the global lithium market size was less than 500,000 tons of LCE a year. The current market size is just under 2 million tons of LCE a year. So the amount of DSO that was being shipped last time had the potential to slightly influence the market, whereas the amount of DSO that's likely to be shipped this time is going to be, in percentage terms, substantially smaller in terms of the market. But what does worry me is the actual projects. So, for instance, Benchmark alluded to a project that's off everybody's radar in Sierra Leone, for instance, a hard rock project. I know that there's a couple of producers in South Africa that have come on in the last 12 to 18 months. There's definitely stuff coming out of Nigeria. You're going to see continued ramp up in Mali. There's material coming out of DRC. Potentially, there's material coming out of Southeast Asia and other regions. So I'm more worried about the genuine sort of concentrate material than I am worried about the DSO, because the quantum of DSO, as Chris said, is pretty limited compared to the quantum of DSO in the last cycle.
Yeah, I'm not worried overall about quantum. It's more like the market signal. It's the canary in the coal mine, as Rodney says. If DSO is economic, it means there's a whole bunch of other supply that's economic that we don't know about that's coming on. That's the point. I'm more with you, Matt, and I'm thinking I'm about to write my lithium bull this weekend, and I just had my 40-year high school reunion, so I'm kind of like in a milestone reunion kind of phase. And it was, not to give too much away, I don't know if I'll do this, but 5 years ago, in 2021, around this time, I was giving a presentation at the Fast Markets Conference during COVID, and it was like the least attended. This year's will be the most attended. That was like the least attended, and not a lot of people went. So I went in there and I came up, and talked about Steve Winwood in 1986. Which is when I graduated high school. That was 35 years ago then. Now that's 40 years ago. So 40 years ago, Steve Winwood, put his Back in the High Life again, and his famous, that song and Higher Love. So I said, lithium will experience higher love. And Matt, you just articulated that we've had dips like this before, and you referenced actually 2021. There was a seasonality, and by the fall, you had a recovery. So I think that's what we have in store here. Despite the fact, actually, Matt, you dated that the day you posted that lithium broke out, right, is exactly after that it started going
thanks
down.
so much for that, Howard. It's very kind of you to point that out. It was a couple of days before lithium topped, but it was very close to the high point. Thank you so much. It's kind of you
we all do our best, but lithium, as I tweeted today, again, Benchmark got some flack for being, a wet blanket, to this bull party. But, it's important to listen to contrarians. Goldman Sachs continues to be bearish. I think in 2027 or 28, they're calling for prices to decline sharply. And everyone got angry at Goldman the last time they forecasted that. And they were...
I mean, the nice thing about being consistent is you're going to be right at least once a cycle. So, if you're consistently bearish, you're going to be right at some point. If you're consistently bullish, you're going to be right at some point. So, it's the guys who change their view that you have to look out for, because, they're the ones who have the potential to either be right regularly or be wrong regularly.
Yeah, but none of us are right perfectly, and it's fine to own that when it happens. And but lithium remains still very young, opaque, and lumpy, and cyclical. And you can buy a dip like this and see higher highs later, or is this going to be a long down cycle like we had, a 3-year bear market? I don't think so. Matt, you don't think so. Chris, you don't think so. And even Benchmark is not calling for necessarily a very long bear market, and they caveat it that their demand is, less bullish than some. And a lot of their supply, to your point, Chris, there's probable, there's possible, who knows? But that's what makes this interesting, and lots of opinions out there in the market reflected in the stock prices. Chris, we very much appreciate your coming and discussing things with us. We have found you to, among all the analysts out there, a lot of them are not willing to kind of like stick their neck out and put, thoughts on specific stocks out there. So we appreciate that you actually do that as an analyst, evaluating projects and then just saying, hey, look, whatever, if Q2 looks undervalued or other thing, you have a preference for hard rock. But your comments on Vulcan, very interesting. Do you think Vulcan is a buy at today's prices?
I don't know if I should comment on that. I mean, if you're bullish on Europe,
I just gave you credit for being
Europe. Yeah. I guess, like what I was saying earlier, like if you're bullish on Europe being more secure with their supply chains, then Vulcan's a great place to be for sure.
Okay, I'll take that as a stronghold.
So
okay, all right. Thanks very much, Chris, Rodney, Matt. Thanks. Have a great weekend, and we'll see you next week.
Cheers.
Great. Thanks, guys.
The main focus is going to be infill drilling and extensional drilling of what we have defined so far based on that inferred resource. Now with that money, it gives us the flexibility to do a little bit more step out. And we're only going to make sure that we do any regional drilling where it makes sense. That's something that would be economic, that would be higher grade, close to surface. From looking at other deposits in the region, they often occur in clusters. I would be really surprised if Cisco were just standing there isolated. There's probably going to be more things. We just have to do the work to fully understand that. So the PEA, we've got to do all sorts of things on the transport, all the way from power to transport, rail and road, rock mechanics, hydrogeology, all that kind of things, just to ensure that any sort of conceptual mine plan is feasible. So the work that we're doing now it's enough to do us all the way to a PFS or even a feasibility level study. So it's doing a lot of variability testing of all the different types of textures of the pegmatite, just to make sure we've locked in whatever processing we're going to do on the conceptual level is actually feasible. Because our infrastructure is so close, that just means that whatever we do find is going to make a lot of sense to develop. So even if this were a 20, 50 million ton project, I think it'd still be great. But we've got far beyond that. We've got close to 300 million tons, which is exceptional.